A Solana ETF, or exchange-traded fund, refers to a financial product designed to track the performance of assets associated with Solana, a blockchain platform known for its high-speed transactions and decentralized applications, dApps. Here's a breakdown of key points related to a Solana ETF. ETF Basics. An ETF is a type of investment fund that is traded on stock exchanges, much like stocks. It holds assets such as stocks, commodities, or in this case, cryptocurrencies like Solana, often via futures contracts or other derivatives. Solana is a blockchain platform that aims to provide fast and secure transactions at a low cost. It uses a proof-of-stake consensus mechanism known as proof of history, POH, to achieve high throughput. Purpose: a Solana ETF would allow investors to gain exposure to the price movements of SOL tokens without directly owning them. This indirect ownership can be appealing for investors who prefer a regulated investment vehicle or who cannot access cryptocurrency exchanges directly. Structure: the ETF structure means that investors can buy and sell shares of the fund throughout the trading day on stock exchanges, making it more liquid than owning the underlying asset directly. Regulation: ETFs are subject to regulation by financial authorities in the jurisdictions where they are offered. This regulation aims to protect investors and ensure transparency in the management of the fund. Risk and return: like any investment, a Solana ETF carries risks such as market volatility, regulatory changes, and technological risks specific to blockchain technology. Potential returns are tied to the performance of Solana tokens and the broader cryptocurrency market. It's important for potential investors to conduct thorough research and consider their risk tolerance before investing in any ETF, including those related to cryptocurrencies like Solana. Bloomberg analyst predicts Solana ETF might bag approval in 2025. He believes an administration change is vital to achieving this feat. Van Eck might have opened the door for more Solana ETF applications. Senior Bloomberg ETF analyst James Seifert sees a Solana ETF product entering the market as soon as 2025. Van Eck files for Solana ETF. Investment asset management firm and spot Bitcoin ETF issuer Van Eck has filed for a Solana ETF with the United States Securities and Exchange Commission, SEC. The submission of this Form S-1 filing makes it the first firm to apply for the proposed rule change in the U.S. Noteworthy, Canadian investment firm 3iQ Corp filed a preliminary prospectus to offer the Solana SOL Fund, QSOL, in Canada about a week ago. The talks about Solana ETFs became intense as several asset managers filed for spot Ethereum ETFs. As the odds for spot Ethereum ETFs approval grew to 70%, many market observers began to perceive that the second-largest cryptocurrency by market capitalization would set the precedent for other altcoins, including Solana. Even Daniel Yen, co-founder of Matrix Port, suggested at the time that SOL could be the crypto to benefit following the approval of a spot Ethereum ETF. Immediately, the SEC approved spot Ethereum ETFs on May 23. Industry experts started looking toward the next big thing, Solana ETFs. Anthony Scaramucci, Skybridge Capital founder, stated that they would soon start working on getting the spot Solana ETF. The chorus for spot Solana ETFs has just continued to grow. Like Seifert suggested, other asset management firms like BlackRock, Grayscale, Franklin Templeton, Fidelity, Bitwise, and others may see Van Eck's filing as a call to join the SOL ETF movement. How to do Solana ETF. Creating a Solana ETF, exchange-traded fund, involves several steps and regulatory hurdles. Here's a general outline of what's typically involved. Investment strategy and proposal. Define the investment strategy of the ETF. For a Solana ETF, this would likely involve tracking the performance of Solana, SOL, tokens or Solana-based projects. Prepare a detailed proposal outlining the objectives, target market, and investment approach of the ETF. Legal and regulatory compliance. Engage legal counsel to navigate regulatory requirements. This includes compliance with securities laws, ETF regulations, and any specific rules governing cryptocurrencies and blockchain assets. Consider the jurisdiction where you plan to list the ETF. Regulatory frameworks can vary significantly between countries. Partnerships and custody. Establish partnerships with authorized participants, market makers, and custodians. Custody is crucial for securely holding Solana tokens backing the ETF shares. Ensure that the custodian has robust security measures in place to protect the digital assets. Index development, if applicable. If the ETF aims to track an index of Solana-based assets, develop or license an appropriate index. This index would dictate the ETF's composition and rebalancing strategy. Registration and approval. Submit the ETF proposal and all necessary documentation to the regulatory authorities for approval. This process typically involves detailed disclosures about the ETF structure, risks, and operations. Listing and trading. Once approved, work with stock exchanges to list the ETF for trading. Ensure compliance with listing requirements and market regulations. Market the ETF to potential investors through authorized brokers and market makers. Ongoing compliance and monitoring. Continuously monitor compliance with regulatory requirements and market conditions. Regularly review the ETF's performance and adjust the investment strategy as necessary. Creating an ETF, especially one focused on cryptocurrencies like Solana, requires specialized knowledge of both traditional ETF operations and the unique aspects of blockchain technology. It also involves navigating complex regulatory landscapes, which can vary significantly depending on the jurisdiction. Working with experienced legal and financial professionals is essential throughout the process to ensure compliance and operational success. An ETF, exchange-traded fund, typically allows investors to gain exposure to an underlying asset or group of assets, such as stocks, commodities, or cryptocurrencies, without owning them directly. A Solana ETF, if launched, would likely aim to track the performance of Solana, SOL, tokens or other assets associated with the Solana blockchain. Here are some points to consider regarding a potential Solana ETF. Objective. The primary purpose of a Solana ETF would be to provide investors with a convenient way to invest in Solana-related assets through a regulated and accessible investment vehicle. Structure. ETFs are structured as funds traded on stock exchanges, enabling investors to buy and sell shares throughout the trading day. This provides liquidity and transparency, unlike direct ownership of cryptocurrencies, which can involve complexities such as storage and security. Regulation. ETFs are regulated financial products in most jurisdictions, providing investor protections and oversight. Regulatory approval would be necessary for any Solana ETF to be launched and traded on major stock exchanges. Risk and return. Investing in a Solana ETF would expose investors to risks such as market volatility, regulatory changes affecting cryptocurrencies, and the specific risks associated with the Solana blockchain technology. Market impact. The introduction of a Solana ETF could potentially increase liquidity and accessibility for institutional and retail investors interested in exposure to Solana's ecosystem, potentially influencing SOL token prices and market dynamics. To find the most current information about a Solana ETF or any developments in this area, it's advisable to check financial news sources, official announcements from ETF providers, and regulatory filings. As the cryptocurrency market continues to evolve, new investment products and opportunities may emerge, including ETFs targeting specific blockchain platforms like Solana.